Hello everyone, it's Professor Reiko here, finishing up our lease chapter. This video is going to focus on the lessor accounting for the residual value. So real quick, before we get started, just remember that when the lessor is calculating the rental payment, they're going to include the residual value regardless of whether it's guaranteed or not. All right, so we talked about that in a prior video, and we determined that was the number right there for the rental payment. So they're going to base the rental payment, they're going to include the residual value regardless. So make sure you go back and watch those prior videos. We use all the same information here throughout these videos, so it's helpful to go back. So all the information that's kind of down here, that's all from prior videos. All right, so when we're doing our initial journal entry, okay, remember, this is important to remember, this is just the initial journal entry. We have a couple of things we need to keep straight. Obviously, we're going to have the lease receivable, and let's read it here. It says present value of the minimum lease payments plus the present value of the residual value, regardless of whether it's guaranteed or not. All right, so this is the same as before. So we should get the same number here that we did prior, and we will see that once we get down to the numbers. All right, the sales price, the sales revenue, notice here it's the present value of the minimum lease payments less the present value of an unguaranteed residual value. All right, so we back out the unguaranteed residual value, the present value of it, because if you think about sales revenue and revenue recognition, if it's unguaranteed, then we really don't know whether we're going to recover that portion of on the lease, and so we can't really consider it, quote unquote, sold since it's unguaranteed. On the guaranteed side, we can. All right, so we'll see a difference between guaranteed and unguaranteed. All right, and then we also are going to back out any unguaranteed residual value here. So since we're backing out the unguaranteed residual value from both the sales revenue and cost of goods sold, our actual net profit on the transaction will be the same regardless of whether it's guaranteed or not. And we'll see that when I get down here to the bottom of the numbers. All right, so this information is similar to it's the same as what we've had in prior videos. So like I said, it's good to go back and watch those prior videos. So let's just compare side by side the guaranteed versus non-guaranteed. All right, so remember, up at the top it says the present value, the lease receivable is the present value of the minimum lease payments plus the present value of the residual value, regardless of whether it's guaranteed or not. So that is why this is the same, because it doesn't matter whether it's guaranteed or not. So we're going to have 250, 192, and that's the number that's going to start our amortization table. So we're going to have the same amortization table regardless of what's going on in the problem. So that's important to remember, because basically our very first journal entry will be different because these numbers right down here are going to be different. And our last journal entries will be different based on whether it's guaranteed or not. But everything in the middle is going to be the same. Okay, so that's important to remember. All right, so my sales revenue on the guaranteed side includes the guaranteed residual value. But remember, we back out the unguaranteed. So basically on this side, we're saying the future value equals 0. All right, so this difference between the two works out to be 46,569. Okay, meaning the difference between the 250, 192 right here and the 203, 623 right here. Okay, so this number showed up in a prior video when we first started talking about residual values and we were calculating the payment. This is actually the present value of the $75,000 residual value. So if you did the present value of that number, you would get 46,569. Okay, so that makes sense, so that's the difference between the guaranteed and unguaranteed numbers, because that's the only thing different in the calculation. One includes a future value of 75, one does not, and so that present value of that number is the only difference between the two sides. All right, for the cost of goods sold up here, it says, remember, it says we are going to back out the present value of an unguaranteed residual value, so that's the 46,569. All right, so that equals 113,431. And then our profit is just our revenue less cost of goods sold. And if you notice here, it's going to work out to be, and this is what I said at the top, the profit's going to be the same regardless of which one we're doing. Okay, so this is kind of how we get to our first journal entry. So let's go on and do the first journal entry. We don't need the amortization table to do that. And so what I'm going to do here is just kind of divide the page, guaranteed on this side, unguaranteed residual value on this side. All right. So on the first day here, we've got the, so remember, we're going to have the same accounts: lease receivable, cost of goods sold, sales revenue, and we'll call this inventory. All right. So on the guaranteed side, now I'm just bringing the numbers down. So 250, 192, cost of goods sold was 160. This was also 250, 192, and the inventory is just the number given in the problem as the cost, which was given as 160. Okay, so that's important to remember. On the guaranteed side, notice how the numbers are all the same. On this side, all four numbers will be different. So we'll have 250, 192. Cost of goods sold was 113,431. The sales revenue 203,623, and then this is the 160. All right. So notice the difference. All right. So the first journal entry is going to be these different between guaranteed and unguaranteed. But then after that, everything's the same. So when we receive our first payment, we're going to have cash, reduce the lease receivable by 48,832, 48,832, and it doesn't matter where it's guaranteed or not when we get to this point. All right, so let's flip over to the next page and take a look at the amortization table. I went ahead and filled it all in just because we should be in pretty good shape on these by now. So you can see here, all right, a couple things to remember. Remember, everything that's in your calculation has to be here. All right, our calculation says where you have 5 payments of 48,832. We want to earn 10% over the 5 years, and we have a future value of 75,000. Okay, so all those numbers make it into my amortization table, and that's important because that's how it works out, or how it allows the table to work out correctly. All right, so in 12/31/07, we're going to accrue our interest revenue. And remember, we do that for the 20,136. Now remember, this is the lessor, so we're not amortizing any right-of-use asset or depreciating asset because we don't have an asset on our books. On 1/1/08, we make the payment. So we'll have cash, lease receivable for the 48,832. Okay, so pretty straightforward. So once we get in the table, it's just like the other it's just like the other sales type lease we did earlier in the problem for the lessor. Now, once again, just to be consistent with how I've done the other one, if the entire payment, let's say the payment date was 12/31/07, not the next day 1/1/08, all right, you would just combine those journal entries. Cash 48,832. You would have interest revenue for the 20,136, and then you would have the reduction of the receivable for 28,696. So a lot of books do it this way, and this is, if you do it this way right here, it's just saving you a little bit of time just doing it all in one journal entry. So just be aware of that. Make sure you understand what's being asked of you in your problem. I like showing the accrual side, but a lot of times they do this side just to speed things up, especially on the and on the lessee side as well. All right, so then we would just continue this pattern over and over and over again until we get to the end of the lease. All right, so let's kind of pay attention to this row right here. All right, so I still on 12. So remember, this right here is the last payment date. 12/31/11 is the last day of the lease. All right, so that's when the future value. So we need to figure out what the asset is worth. So if you see down here, the asset is worth 65,000. All right, so now it matters whether it's guaranteed or not. All right, so let's do this. The 12/31/11 journal entries. All right, so I'm going to do it as 2 separate entries. So the first thing I'm going to do, so this is 12/31/11. I'm going to record my last little bit of reduction of the receivable and recognition of the revenue. All right. Actually, we can just combine all that into one journal entry, so I'm not going to worry about doing that. All right, so scrolling back up here, so if you look here, we still have to recognize 6818 of interest revenue, so that's a credit. We also have to credit lease receivable for 68,182. So those are 2 credits there, which means we're going to need 2 debits totaling 75,000. All right, so let's scroll back down here. So let's just break our page up into guaranteed and unguaranteed, like we did earlier. All right, so we are getting back, and we'll call it inventory since we got inventory in the first one. Okay, so we're saying we're getting inventory back worth 65,000. All right. On the guaranteed side, it's only worth 65, so they're going to make up the difference in cash, right? Because they guaranteed it, so they have to give us something back worth 75. So they're giving us the inventory back, and the cash. On here, there would be no cash. On that side, there would be a loss on the leases, on the finance lease, for $10,000. Okay, so there's my 75 worth of debits, and now my credits, remember, so just scrolling back up, my credits are going to be the interest revenue and the lease receivable. So I'm going to have interest revenue for 6818, and we'll have our last reduction of the lease receivable for 68182. 68182. Okay, so remember, this is now 0 because that's our last reduction of the receivable. So we've got that we gave back the asset, or I guess we're the lessor here. So we received the asset back, trued it up whether it was guaranteed or unguaranteed, recognized our last little bit of revenue, and then closed out the lease receivable account. And then we would be done with this lease. Okay, so this is a sales type lease. So just in my experience when teaching this, it seems like sales type leases give students the most trouble. Okay, but just remember the table right here, the amortization table, it's the same. Okay, because it's driven by what you calculate that lease receivable to start with. Okay, so that table, you know how to do that. The things you have to be really careful about is the very first journal entry that we saw on the previous page, and then our final journal entry, because those two are what are going to matter based on whether it's guaranteed or not. All right, so this kind of wraps up the chapter. There's a few other things I didn't talk about, like bargain purchase options. They're very similar to how a guaranteed residual value factors into a problem. I will maybe try to do pull one of the homework problems out of one of the books and add an additional example that includes bargain purchase options to kind of go through that. Sometimes your books just mention it but don't really do an example with it, but then they usually have a few in homework. So maybe I'll try to add that in at some point later. But hopefully this gives you a pretty good grasp on leases throughout. Remember, I think it's a difficult chapter, a lot to keep straight, so use these videos to your advantage to kind of get you prepared for the test. All right, so we will kind of keep moving along, and we'll pick up a new chapter next time. Thanks.